Good afternoon and welcome to the Meridian Energy results announcement for 2016. While overall national demand for electricity was flat in the year, generation volumes for Meridian were strong, and the company achieved record levels of production in New Zealand at 13,707 gigawatt hours when adjusted for the sale of the Tekapo power stations in 2011. This represented a market share of around 32%. It is pleasing to be able to announce for the fourth year in a row, Meridian has recorded an increase in our principal operating profit measure, or EBITDAF, and in all other financial measures other than NPAT, which was affected by fair value movements during the year. EBITDAF was $650 million, up 5% on last year as a result of an improving New Zealand energy margin, which was up over 4% and a nearly 30% lift in the contribution of Australia. In New Zealand, we benefited from higher retail margins and increased generation volumes, enabling higher wholesale sales and lower hedge costs. On the cost side, as Paul will explain later, operating costs excluding growth initiatives were held flat. In Australia, both the generation business and Power Shop, our retail operation, performed ahead of last year. The NPAT result was down 25% for the year at $185 million, principally as a result of fair value movements of hedges and financial instruments. Backing out the effect of fair value movements and other one-offs, underlying NPAT was $233 million, nearly 11% up on last year. Operating cash flow was also up for the fourth year in a row at $452 million. It was pleasing to again see the stay-in-business CapEx at $59 million, well under the $65 million per annum we indicated at the time of the float. The ordinary dividend for the second half will be 8.4 cents per share, which brings the total ordinary dividend for the year to 13.5 cents per share, a 5% improvement on the dividend for the previous year. This represents a payout of 83% of free cash flow as calculated pursuant to our dividend policy. The dividend will be paid on 14 October and will go ex on the 29th of September. It will be 90% imputed. So on to the capital management program, where we earn the praise of the quiet and the wrath of the vociferous. The board believes that there is no reason not to continue the program, given trading results are positive and there is no material risk to earnings on the horizon, albeit the view forward for a company such as ours, with a reliance on Mother Nature for fuel, is necessarily relatively short. The board then considered whether it is appropriate to make a distribution by way of a share buyback or a special dividend. The board decided that given the current share price and the difficulty in completing a buyback program at less than the assessed share value, it is more appropriate to pay a special dividend of $62.5 million or 2.44 cents per share, which will be paid and go ex on the same days as the ordinary dividend. This brings to $187.5 million the amount distributed since August last year, when the board announced its 5-year capital management program, which aims to return $625 million to shareholders. While we get mixed feedback on the vexed question as to the relative merits of buybacks versus special dividends, the weight of opinion still supports distribution by special dividend, despite the fact that it is unimputed. There may be some that consider our returns, whether by way of ordinary dividend or the capital management program, a tad conservative, given our strong balance sheet, but until such time as there is more certainty as to the Tiwal Point smelter's longevity, we will always retain conservative debt metrics to allow us to absorb an exit and a year of poor hydrology without significant stress on the balance sheet. I'll now hand over to Paul to talk about progress on strategy.
Our focus is always on delivering strong and stable cash flows to our investors with some incremental growth. I'm going to update you on some of the areas that underpin this, and this builds on some of the material which you would have seen at our last Investor Day. We believe that a stable open market and a level playing field are what deliver the right results for consumers in terms of security, service and value, and in terms of renewables. It's good to see some progress on one of the level playing field issues and transmission pricing, and Mark's going to cover some of the more controversial detail a bit later on. But really for me, the big standout is how competition is delivering to consumers, with 31 brands in the market, over 20 separate independent suppliers, and we're seeing lifts in service, innovation, and now some price movement. So the average residential price has actually declined over the last 2 years. Our biggest focus is always on enhancing and protecting our core assets and earnings, but we do want to offer, as I said, incremental growth. Our overseas retail initiatives are now still tracking to plan. Australian numbers are over 80,000 as I speak, across New South Wales and Victoria, and the UK development for npower is in line with hitting the first delivery milestone at the end of the year. In New Zealand, we will be ready when demand supports a new build, and Mark again will touch on where we believe that will be. And we have wind options in the low $70 range, which is a significant improvement on where we've been before, and with the ambition to further improve in that space. Obviously, effective operation of our generation assets and efficiently managing our wholesale exposure are the biggest drivers of that strong cash flow. It's been good to see the next steps toward reconsenting the Waitaki scheme in 2025 this year, in collaboration with Ngāi Tahu and irrigators, delivering some great outcomes in terms of minimum flows and additional flexibility in the operation of Lake Pukaki. We see the industry as having seen the right outcome in respect of Huntly, and that as a result we've ensured security of supply, which is in the end what consumers demand. And by the way, that station has operated 60% less on coal this year than last year, so there's no correlation between signing an agreement of this nature and the use of coal. And of course we've seen reduced overall exposure to NZAS, which again we'll talk about more later. We admitted a while back that our retail business had underperformed its potential, and this has been a big area of focus for us in the last 3 years. So it's great to see another year of improved service and of improved segmental profitability, closing the gap on where we wanted to be. You'll see later that all of our key metrics are tracking in the right direction. However, it's clear that competition and continued level of switching means that we have to keep the momentum up and continue to improve. I'll now pass you over to Mark, who will start with our most important issue that we can't get wrong.
That's health and safety. Our total recordable injury frequency rate increased in the year, which is not what we would like, and there can be no excuses. Having said that though, we had no significant harm injuries in the year. The highlight for me personally was the fact that our annual engagement survey of employees saw a continued improvement in the safety-related questions relating to the company's commitment to safety. We were markedly ahead of the energy sector benchmark and better than the top 10% of the companies in the survey. While we had been mildly optimistic last year that we were seeing some signs of demand growth in New Zealand, the year has seen demand almost flat. Unseasonably warm weather in autumn and winter has almost certainly been a contributing factor, but picking a long-term trend with confidence is difficult given the number of variables at play. However, we believe economic growth and the positive levels of immigration being experienced will lead to overall medium-term growth in the market. Probably the supply side of the market has been of more interest over the year, with over 800 megawatts of thermal retirements over the last 12 months. While the retirement of the remaining 2 Rankine units at Genesis' Huntly plant was also flagged, we made it clear that in our view this closure would have led to significant issues for the market in periods of peak demand and low inflows into hydro lakes. Accordingly, we were prepared to improve our offer to Genesis for a continuation of our swaption agreement on more flexible terms. That has allowed us to secure dry year cover through to 2022, a win-win outcome. While New Zealand electricity generation is now north of 80% renewable, the effect of not having sufficient backup capacity to support renewables can be very costly, and has been well illustrated in South Australia over the last few months, with thermal plants being progressively closed as they are no longer economic, leaving the state potentially exposed when the wind doesn't blow. Wholesale energy-only prices in July averaged $229 a megawatt hour in South Australia, in comparison to $64 in neighbouring Victoria, as wind volumes were low and there was insufficient backup generation available, forcing the state government to contract the owners of a mothballed gas plant to bring it back on stream. The contraction of supply we have seen with the withdrawal of thermal units in New Zealand will inevitably lead to greater level of volatility in wholesale prices in peak and dry periods. This follows a prolonged period where the market has been in oversupply, and as a result, volatility in prices has been muted. Some volatility is a necessary aspect of any market and provides appropriate price signals. Although short-term forward prices have fallen as a result of currently good lake storage levels, 2017 and 2018 ASX prices are up over the last year, probably reflecting the tightening supply in the market. Transmission pricing. What can you say? The process continues, Christmas is coming, and the lawyers get rich, or the lawyers get richer. We are totally supportive of the EA's position, admire its fortitude, and believe it is appropriately signalling a more equitable and durable approach based on the underlying principle of user pays. While nobody in this debate other than the EA is truly impartial, the underlying principles underpinning the need for change are difficult to argue against, and hopefully most New Zealanders can look past some of the rhetoric coming from interest groups in forming a view as to the equity and fairness of the proposed changes. The Australian market. Overall demand in the Australian market is subject to the same factors driving demand up or down as in New Zealand, with the notable exception that small-scale solar penetration is far higher and unlikely to slow materially as Australia transitions away from heavy reliance on coal-fired generation to renewables. That said, the regulatory framework supporting renewables requires attention if longer-term goals for renewables are going to be achieved. Despite the bundled price of energy having averaged over $134 per megawatt hour in Victoria over the last 6 months, well in excess of the price required to warrant new generation, the market is not being inundated with new projects. Lots of talk. The problem being that the Renewable Energy Target Scheme, which underpins the transition to renewables, has aspects of uncertainty that are making it difficult for developers to obtain long-term take-off agreements and finance. As matters stand, we would see it being difficult for the government to meet its stated target of 33,000 gigawatt hours of renewable generation by 2020. With a very slim parliamentary majority, it is perhaps wishful thinking to believe that the shortcomings in the scheme will be addressed in the term of the current government. I'd love to be proved wrong. Tiwal Point smelter, Groundhog Day. I think I'll give up reading the nostrums of so-called market experts on world capacity, prices and cost curves. A 12-month review always reflects that they are wrong. Suffice to say that in our view, the smelter's competitive position, based on what we can observe, has not improved, with international aluminium prices broadly similar to 12 months ago, but with a doggedly high New Zealand US dollar cross rate. As the market is aware, the smelter's owners have a perpetual right of termination and an electricity price increase, both of which become operative from the 1st of January 2017. To add extra flavour to the mix, The smelter is also a potential beneficiary of proposed changes to transmission pricing methodology, the direction of which should become clear within the next few months. On Monday night, I saw an article in the Australian Financial Review suggesting that Rio Tinto's Australian aluminium smelters were going to again be offered for sale. Given this is just a restatement of where we were 4 years ago, it doesn't alter our thinking on Tiwai at all. So in summary, as an intensely interested but ultimately ignorant observer, our assumption is that whether the smelter is owned by Rio Tinto or AN other, it will still be with us this time next year and no termination notice will have been received. For the first time in 5 years, we have had a wet late summer and autumn, with catchment inflows 108% of average. We were able to generate at record levels after, as I say, adjusting for the sale of the Tekapos in 2011. Generation at 13,707 gigawatt hours was up 3% on the prior year. With the reduction in thermal capacity in the market, our estimates of when new capacity may be required has come forward slightly to between 2019 and 2023. We believe that a Meridian wind option will be close to the top of the merit order for construction in this or a shorter time frame should it be required. The work that we have done to date indicates that the capital cost of wind projects is reducing. So cost reduction is not just a solar story, and we are very confident in the operating assumptions we are making after outperforming our business case on nearly all metrics on the Mill Creek investment that has now been operating since May 2014. Retail. Retail is detail and a battle of inches, but our customer service measures and retail metrics improved during the year. And undoubtedly, as Paul said, the highlight was the fact that we had a significant financial improvement, up 23% on last year, or $13 million in this segment. While ICP, or customer numbers, were slightly down, volume was up in residential, small medium business and the agricultural segments, and average prices increased by 3%. The initiatives in the small and medium business space are delivering growth, while we would acknowledge that the residential segment remains challenging. In the corporate and industrial market, we had a reduction in volumes as prices came under pressure with heightened levels of competition. I'll now get Paul to talk about the numbers in more detail.
Just starting with a bit more detail on dividends, Mark's already covered the underlying logic behind the capital management program. So obviously 2 tranches of that were declared in the year. The ordinary dividend itself, the growth in that is a little ahead of free cash flow growth, with an improved imputation ratio compared to last year. And we do see scope over time of increasing the percentage payout of free cash flow, with the underlying aim of providing shareholders with a strong, reliable and growing dividend flow. This page I'll probably just flick over. It's just a whole load of bars that are all better than last year apart from one. So we'll move on. Don't have to explain anything away there. Obviously, very pleasing to have a 4th year of growth in both energy margin and EBITDAF. Last year we had a bit of a boost from insurance proceeds, and excluding that we had a growth overall of 6% in EBITDAF, with the material contributors being, as Mark said, retail volume in the mass market area and an improvement in average price through that shift in mix. A big lift in Australian margin with power shop growth, the confirmation of the RET and the firming of underlying black prices with tightening of supply. And of course, record generation volumes underpinning it all, leading to higher volumes sold on spot and less required to cover our risk position. This was offset by some cost growth, and I'll cover that with the next slide. At the interim, we reported a $9 million lift in operating costs first half on first half. The second half saw a much more modest $1 million lift. So of that overall $10 million increase, the entirety of it has been on investment in growth in Australia and the UK. Across the rest of the business, and you'll see this in the segmental accounts, we've seen no increase in cost, and that's despite quite a lot of competition-driven cost pressure in retail, cost pressure in terms of the rollout of smart meters, and some negative reclassification of costs on the after the sale of ARC. So quite a positive note for me. We've also, as Mark said, delivered on the capital expenditure plan, and the major part of that has been either on improvements in our retail business, growth in Australia and the UK, or asset. And the big item there has been the Waitaki station refurb, which is going on right now. Turning to costs below the EBITDAF line, the drop in NPAT year on year really includes two large differences. The first of those is fair value movements, $50 million worse than last year, driven by two things: the shift down in interest rate curve globally, how low can you go, and we have a large swap book, so I understand why that would lead to that, and the lift in the LGC forward price and its impact on our forward sold LGCs. We also released $62 million of tax provisions last year, which bolstered the numbers in 2015, and we've returned to a more normal charge this year. Underlying NPAT, excluding these non-cash items and one-off gains, was up 11% on last year, again, fourth consecutive year of growth, and reflecting both the higher EBITDAF and stable interest costs, with higher levels of borrowings being offset by a lower overall rate. And look, while we are covering tax matters, it's just worth noting that we have analysed the impact of the recent Supreme Court judgment on Trustpower, which massively reduces the ability of businesses to deduct feasibility costs for tax purposes. That doesn't have an impact on this year's result. We have taken a fairly conservative approach in the past, but we believe it has a potential to stifle innovation and investment in a wide range of NZ industries and does require legislative attention. I'll pass back to Mark for a wrap-up.
Thanks, Paul. We could not have started the new financial year in better shape, and as at yesterday, our key catchment, Lake Pukaki, was 162% of average in terms of stored energy. Not surprisingly, generation volumes in July were nearly 7% up on last year. As previously noted, we are experiencing more trading periods where prices are proving volatile as transfers across the DC link become constrained in some circumstances. This will see wholesale prices occasionally at higher prices than have been observed over recent years. This will not be an issue for most retail customers who are protected from such fluctuations as a result of fixed prices. However, consumers who have chosen to accept spot exposure will need to be more cognizant of this risk. Meridian has a retweaked executive management team following resignations in the year. 4 roles have new incumbents and 3 were internal placements, underlying the bench strength in the company. And I have a very high degree of confidence in these people individually and as a cohesive team. Clearly, we have to deliver on the npower initiative in the UK. PowerShop needs to ensure that npower is in the market in January next year. It will be a key focus. Clearly, our major customer, New Zealand Aluminium Smelters, has some interesting discussions coming up with its owner, but the fact that Rio Tinto may again be looking to sell the plant in no way alters our position. So in summary, it has been a very good year. We have started the new year well, and we look forward to progressing further improvements in the year ahead. There endeth the lesson. We will now open it to the floor for questions. We will take questions from inside the room first, then we will open it up to those that are participating via the video link. So inside the room, questions. Neville, I knew you'd be first.
Thanks, guys. 2 questions to start off with. You talked about sort of low 70s wind unit cost for sort of some of your best wind projects, and sort of flagged that you thought they could potentially be ready, or needed by the market 2019, 2023, in that range. What's your view? A couple of questions in respect to that. One is, what do you think that means for long-run prices? Are they going to sit still above that 70, low 70s? And the other is, how much does sort of the lower for longer view on the cost of debt affect, and potentially rates of return generally affect that pricing? That was one question, believe it or not. And the other is just a view for HVDC charge going forward, obviously between now and whenever TPM does or doesn't happen.
Okay, so the pricing impact. So first of all, just to touch on the drivers of the reduction, which is coming from manufacturers' price reductions rather than cost of capital factors. And that really reflects the reduction in subsidies, principally in Europe, and the need for them to compete head-to-head with coal. When you're looking at the long-run marginal costs, we see the sites as more critical to price in the end than technology. So we still believe that as you go through the better sites, you have an upward slope. But we've never sort of put a stall out as to what we believe long-run prices, or not for a long time anyway. So that's for you to make your minds up on. On HVDC between now and wherever, you can have a look. Theoretically, real pricing should start to drop a little bit in 18-19, I believe. There's a chart somewhere on Transpower's website, which I've got. Someone emailed it to me yesterday. I asked the very question. Next year will be pretty much flat to this, I think. But you have to see some of that Pole 3 cost start to dwindle away. And they have some quite odd mechanisms for catch-up and stuff, which can mean you can be surprised a little.
Just on the turbine manufacturers, Neville, I mean, we've seen since we last priced the project that we have just recently tested, turbine prices have come down about 11% for us in New Zealand dollars, and that is with European manufacturers, not Chinese. So, the cost improvement story, everybody talks solar, but I don't think you can say it's all over with wind either. We were very encouraged.
No desire to review your hurdle rates?
Look, I mean, our hurdle rates are driven off our cost of capital, as you know. So, I mean, what appropriate premium we get for the development risk that we take. But, I mean, clearly having development options in the low 70s gives one a little margin for error. We're very encouraged. We'd be very surprised if anybody had anything much better. We would imagine our top option would be very close to the top of the merit order. Any other questions in the room? No, none inside the room, so we'll throw it open to people who are attending by video conference, or whatever you might call it, in the ether.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you wish to queue for a question, please press 0 followed by 1 on your telephone and wait for your name to be announced. Your first question comes from Wade Grudder from UBS. Please ask your question.
Hi, it's an interesting pronunciation of my last name. Just quickly, a couple of things. Just follow up to what Neville was saying about long-run marginal cost. You said you thought you could get more improvement from there. Any idea of how much scope and where is that coming from? Is that coming out of manufacturers as well, or other areas?
It's largely manufacturers and the technology type. I mean, that also, by the way, extends out to the O&M cost, because if you can get less moving parts into a turbine, you clearly have less of an issue in terms of maintenance. So it's partly technology, but it's partly the economics that are being forced on these guys. They were effectively in a position where they could charge up to a certain price because it was supported by subsidy to that level. You take that support away, and they have to become more competitive with coal, basically.
All of these new prices
what's that?
All these new prices are based on direct drive technology. No gearboxes, lower operating costs.
If it's them, if it's being forced upon them, any idea then how much scope they've got to fall further? Because I've sort of assumed that a similar sort of impact will happen if and when grid scale solar comes down. In the end, the wind guys need to respond and drop their prices to compete.
Very difficult to gauge just what further scope that they have, but I mean, I can say, Wade, that we have been working with one manufacturer to try and drive costs down to a number that begins with a 6. So, I mean, the ambition is to get down, and I mean, it's right across the board, in terms of foundation sizes, balance of plant, as well as the turbines themselves. They're looking to make some gains and some improvements, obviously, in their supply chains. And remember, this is this last example that we talked about was a very well-known European manufacturer that probably doesn't have a big reputation for providing the lowest prices. So we were very very pleasurably surprised.
Okay. Other question I had is, from the presentations we've seen in the last day or over the last week from your competitors, there's a big focus on retail innovation. Are you comfortable that you are keeping pace with what they and also these third-party retailers are doing in that space?
Yes. Do you want?
I thought that might be your answer.
Yeah, look, we are. I mean, undoubtedly you can invent some system to, make a cup of tea for your customers if you want, but what's the cost of that, Wade? And I mean, you can slice and dice some information probably with some systems in a million different ways, but it has a cost. And do you value it? I mean, when we look at some of the systems that some of our competitors have, there might be levels of functionality in there that are greater than ours, but boy, let me tell you, it comes at a far higher cost, and our evaluation provides probably very little utility for some of the customers. So it's a value for money type equation, and we think we're doing pretty well on the metrics that we're measuring in terms of providing not the lowest price, but a fair price and good service to our customers, which at the end of the day, I mean, all the analysis will show people take more time picking a pair of socks in a year than they do deciding anything about electricity.
I think it's worth just adding a couple of things. One is that I think one of the keys is your ability to analyse position, to have strong analytics, and we do have strong analytic ability in our retail businesses. We have spent a lot of time and focus on that, and that is what you need in order to decide where you're going to spend your dollar, rather than sort of splash effect over the whole customer base. And the other thing is that there's when people talk about retail, they really are speaking generally about the residential market, and it's got to be remembered that business market, which makes up in volume terms by far the bulk of our sales, has been underserved somewhat in the past, and we are quite heavily focused in that area, and you have a lot of customer developments that aren't seen by the general public there.
A small and medium business customer has probably on average about 2 to 3 times the load of the average residential customer. So, I mean, as we've made no secret, I mean, it's an area that we're most certainly focusing on.
Okay, thanks.
Your next question comes from Grant Swanepoel from Quiet Investments. Please ask your question.
Good afternoon, team. Just on your wind development or your potential to build, now it's pretty obvious that if you get a 6 in front of it, it'll be ahead of the merit order. But is wind what's really needed, particularly when you talk about peak daily volatility and dry period volatility increasing? Is a peaker not needed, and what are your thoughts on that front? And then just, I know, Mark, your answer is going to be no, but could you elaborate a little why you don't give guidance, particularly in that Mercury is now giving such clear guidance based on a hydrology expectation? And finally, on your dividend policy, no, I'm not going to go to special dividends with no imputation. I was just wondering why the 500 million special has not been changed, considering your earnings have been a lot stronger and your debt isn't climbing as I think the policy was intending it to do. I know it has climbed a little bit, but not as much as the policy intended. Thank you.
Okay, what was the first question again? It's the Alzheimer's kicking in, Grant.
It's around the merit order. Mark.
What was it?
Yeah. I mean, it was around peakers, wasn't it? I mean, look.
It's around what's needed.
Yeah. I mean, we can most certainly see potentially another peaker coming into the market, and I mean, it's open knowledge that that has been considered by and is being considered by Todd. But despite several false starts, nothing has actually materialised. So yes, we could see some more peaking come into the market, Grant, for sure. But I mean, we think there will be space for either wind or some geothermal in that time frame that we are talking about.
You've got growth in capacity need and growth in baseload need, and they are two different things that need to be serviced by different sorts of plant. And, you know, with a system which has as much hydro as New Zealand does, there's a lot more capacity to absorb short-term variability from something like wind, which has very limited variability year on year. So we don't see any issue with that as a provider of baseload growth.
In terms of the guidance, I mean, that has always been the board's very clear view since the time of the IPO, that no guidance would be provided. I mean, Mercury do have the benefit of having geothermal, which perhaps is a little bit more predictable. But I suppose our answer would be, Grant, that you guys have very good models. Everybody is provided with monthly operating data, and all the materials are really there for market participants to pretty reasonably, as you can see from the range of consensus results, or forecasts, should I say, for this year, people aren't too bad at getting a bead on where our results will actually be. So we put a point result out like that, I would say, I mean, to meet it, you'd have to be manipulating your numbers in this game. So we would rather stay with a policy of giving you the material, you guess, you earn your money. Last question.
Thanks. Can I just go push on?
Yeah, last question was...
Push on that first answer.
I know you think we're too conservative, our balance sheet's too strong, our metrics are too strong, and shareholders should get some more money back. And see a little bit of nodding in the room. Paul, do you want to beat Grant up?
Hey, we've just had a year with exceptional hydrology, Grant. There's no real interest for us in seeing stuff go up and then go down and get highly volatile in terms of dividend flow. You should expect that percentage of free cash flow to grow over time. There is scope to move, but it's not going to come out exactly in line with whatever plan you might sort of put in place at the beginning, because you will have variability in hydrology.
Grant, you do, of course, note that, I mean, our dividend has been increasing year on year. I mean, it's a very nice slope. I like the slope. I would hate to see it go into reverse. And given we are very reliant on hydrology, you have to have a little bit of scope to be able to pay an increasing dividend in a poor hydrology year. So yes, we do have a little bit of ammunition, but we would rather feel with some confidence that we can increase our dividend year on year. I know that's not going to
Thank you.
satisfy you.
There are no further questions at this time. Back to you, sir.
All right. No other questions? Then I will declare the meeting as it is closed. Thank you very much for attending.